Hello, everyone. This is our freight market update for May 17, 2022, episode 202. I'm Dean Croak, market analyst here at DAT Freight and Analytics. I'm in for Ken Adamo today. And as always, I'm joined by our principal data scientist, Ned Damon. And we have a very special guest today, Hayley Buckingham's joining us. She's manager of our data science division and coordinates a lot of the research and engineering behind our analytics products, such as Ratecast, market conditions, etc. So good morning. How are you both?
Good morning.
Good morning.
Happy to be here.
Yeah, good.
Yeah, doing
Welcome.
all right. Spring might be coming to Portland finally.
Yeah, so the sunny part of spring. We've had the rainy part, but yeah, it's been pretty lately.
All right, good. Well, so Hayley, tell us a little bit more about what you've been doing. You've been at DAT for a year now. Tell us a little bit about how you got here and what sort of experience you bring to the company.
Yeah, absolutely. It's really fun to be on the show. I've been watching for a while, especially working so closely with Ned, getting to see all the things. So it's fun to be here. But yeah, I've been here nearly a year, if not quite. My background is in data sciences and the engineering that goes into getting all the different models and forecasts and mapping data and all of those things that kind of drive these data-driven insight products. I've done that in fintech. I've done that in cybersecurity. And my educational background is actually in wildfire policy and management, also using, big analytical machine learning kinds of products. So kind of if not running the gamut, then at least a good fraction of whatever the gamut is for data sciences and machine learning.
Wow. Yeah, I love all the work you're doing. Certainly helps take the uncertainty out of freight in these rather turbulent times. So with that, let's get into the show. Yeah, let's dive in. For those that are new to the program, we're here every Tuesday, 10 a.m. Eastern, 7 a.m. Pacific, talking about trends in the freight market. But most importantly, we want to answer your questions. They tend to pile up towards the end. We missed a couple last week, but did answer them via follow-up email. So get your questions into the chat section early. We've got a team in the background that's working on these to get them over to us so we can answer them as quick as we can. So with that, let's dive into the freight market update. This week, spot rates down another 5 cents a mile for all three equipment types. So when I average all three, they're down about 33 cents a mile year over year. Shipper contract rates up slightly in the last fortnight, definitely signs that they are peaking. But interestingly, replacement rates on the contract side coming into routing guides are still increasing, but increasing at a slower rate. On our top 50 lanes, average rate is $2.31 a mile this week, excluding fuel. That's 30 cents a mile higher than the national average. According to JD Power, used truck prices have crested. This is a very interesting data point. 4-year-old sleeper tractors are still about 136 higher than the average from 2008 to 2019. So when you look at that Great Recession to pre-COVID era, where used trucks, 4-year-old trucks averaged between $30,000 and $50,000, they peaked at $118,000 this year. Just extraordinary on the used truck side. But there's definitely signs, according to Chris Visser at JD Power, that we're on the downside of that market peak, and rates have slid considerably in the last half of April. Record volumes in Port of Charleston as we see this west to east coast container shift continue, up 34% year over year. Savannah is another big port. It's the number 4 port in the country for imports. It's also, I think, number 2 for exports, or maybe number 1 for exports, up 12%. Norfolk, similar effect, number 8 in the country, up to 10% year over year. This is a pretty important week for carriers. As you know, we've got Road Check Week starts today, the 72-hour blitz, focus on wheel ends, tires, wheels, brake linings, hubs, seals, all those sorts of good things that keep you rolling. But also don't forget that your submissions are due on, I think it's June 3rd, thereabouts, but it's only 17 days away if you want to make a submission to the FMC CSA on the new proposed speed limiter ruling they're working on. East Coast, there's some breaking news, of course. Yesterday, we saw record high fuel prices, very tight supply on the East Coast. They've lost a lot of refinery capacity in the last 15 years. Prices here in New England were up 4 cents yesterday, but down 1 cent nationally. But the prices here in New England are up around $6.43 today. That's double in the last year. And according to Professor Jason Miller this morning, news just in, the Federal Reserve Board just released the industrial production data for April. A lot of truckload volume comes from industrial production, excluding computers and other electronics. It was the second highest reading in the industrial production index since the end of the Great Recession. Only July 2014 was higher. So certainly some good news on the demand front. Industrial production drives a lot of volume for truckload carriers. That's a really important number as we look to demand signals for the rest of the year. So let's dive into our weekly market update. Let's start with dry van load to truck ratio. Load post volumes continue to track with 2018 from a demand perspective. Equipment posts are tracking the closest with 2019 and 2020. Both were down years for truckers. So if you're thinking about what does the current market look like, demand looks like 18, supply looks like 2019, 2020. Load post volumes are about 42% lower than this time last year. Equipment posts did increase last week after being flat for the last couple of weeks. The load to truck ratio ended last week at 3.44 loads per truck. In the refrigerated category, almost identical to 2017 in terms of the load to truck ratio, increased to 5.40. Load post volumes in the refrigerated sector are about half what they were the previous year and about 8% lower than 2018. In the dry van sector, flatbed load post volumes dropped 18% last week. That sent the load to truck ratio down by almost the same amount. It ended the week at 57.56. I think more importantly, carriers are posting their equipment for loads at around double the volume compared to the previous year. So there's a lot, capacity is a lot looser. Carriers are looking for a lot more loads on the market. So those volumes are about double, which is an interesting data point. Let's have a look at the market condition index. Lots of color on the chart, as you can see there. We took a little bit of a look at the two intra-Canada lanes that are connected to the automotive industry this week, Detroit and Laredo to Toronto. There is some evidence capacity is returning to these lanes, according to our sister company in Canada, LoadLink. There's not a lot of supply coming back, but there is some coming back. We had Chuck Snow on our show a few weeks ago, and he said that cross-border market has lost about 20% of its driver pool who are no longer crossing the border. On the what I call auto alley lane from Laredo to Toronto, rates typically run around $1.50 a mile, but that was up until the February blockades. As a result of the blockades in February, Laredo into Toronto jumped 41% to $2.37. It ended in April at about $3.02. This week, rates are down 9% to $2.75. So rates are coming back down from the peak disruption caused by the February blockades. Similar trend, Detroit to Toronto, another very busy lane for automotive parts. Spot rates typically sit around $640 a load. That's excluding fuel. Load rates jumped by 30% to $1,060 during the blockades. Then increased another 20% to $1,251 a load at the end of April. This week, rates are down 13% to $1,085 per load. So evidence that there is some capacity coming back on some of those lanes affected considerably by the blockades. Augusta, Maine, not a large freight market this week, but significant compared to the amount of empty miles carriers have to factor in between load points. There was also evidence of that this week as carriers are looking to run fewer empty miles as record prices of diesel hit the market. Capacity was tight in Augusta, Maine. Spot rates are up 28 cents a mile to $2.40. Capacity was also tight in the Flagstaff market. Spot rates jumped 29 cents a mile to an average of $2.22. And in the southeast, where produce season is underway, dry van capacity tightened, of course, as reefer carriers switch over to higher paying loads of produce. Outbound rates increased for about the third week in a row in dry van in the southeast region to just over $2 a mile. On the west coast in Los Angeles, one of the lanes we've been tracking for the last year during the surge of imports on the Chicago lane out of Los Angeles, rates continue to drop, capacity continues to loosen, now 68 cents a mile lower than this time last year. The average last week was $1.73 per mile. Having a look at the refrigerated market, strawberries, of course, are in season. May is always a very sweet month for carriers. Volumes are starting to increase, but we're seeing lower reefer spot rates this season. Growers, of course, are happy about that compared to what they were seeing last year. In California, in the Fresno market, rates dropped 7 cents a mile last week to $2.26 as an average outbound rate. That's the fifth week of decreasing spot rates, and it's the third successive week of lower load post volumes as the Fresno market really struggles to get going from a volume perspective. Some lanes a little bit different. Those spot rate roads for Fresno to Chicago They were down under $2 a mile for the first time in 12 months. That's significant, averaging $1.87. It's about 51 cents a mile lower year over year. Normally you see rates head the opposite direction on that particular lane. One of the big lanes for team carriers out of Fresno on the produce circuit is Hunts Point, New York, the big produce market. They followed a similar trend. They dropped 12 cents a mile to $2.04. That's about 83 cents a mile lower than this time last year. So capacity on the reefer side is incredibly loose in that very large produce market. Of course, following Mother's Day, capacity loosened in Miami and Lakeland. Rates dropped 40 cents a mile to $2.14. Capacity was tighter though on some lanes. One of the really big lanes out of Miami and Lakeland is the run to Atlanta. I think it's about 440 odd miles. Rates jumped 50 cents a mile above the April average to $2.30. That's still 22 cents a mile lower than this time last year. We covered the Southeast produce season in the dry van sector, and although it's starting to produce higher volumes, growers are still finding plenty of available reefer capacity this week. At a regional level, spot rates dropped 32 cents a mile to an average of $2.22 in the Southeast. That includes Florida, Georgia, Macon markets, even Savannah. Capacity was pretty tight in Savannah and Macon markets. Spot rates in those two combined increased 8 cents a mile to $2.78. Truckload capacity between Macon and the Miami 600-mile lane, spot rates are averaging $3.74. That's about 40 cents a mile higher. So some good opportunities for carriers on some of those lanes, but generally the trend is downwards in terms of spot rates at a time of the year when they normally increase. And in flatbed, we took a look this week at the steel market, according to some data from the American Iron and Steel Institute supplied by Standard & Poor's Platts. Steel output in the US in the week ending May 7 was down 3.1% year over year. And in truckload equivalent terms, that's roughly 27,000 fewer truckloads of steel this year. The Great Lakes region is always one of those. In the Great Lakes region, decreased 21% year over year. Sorry, not year over year, but compared to the 2019 January to April period. So volumes are down on the 2-year view. Southern region also is a large production region. Volumes are down in the southeast region compared to 2019 levels. Steel production is down 2.5%. A couple of big markets we looked at this week in the southeast: Columbia, South Carolina. Spot rates for loads to New York City saw a 12-month high of 461, but that was in April, but have declined about 430 since then. Mobile, Alabama, another decent steel market. Spot rates are up 38 cents a mile last week to 336. Capacity very tight in Miami last week. Rates are up 15 cents a mile to 189. And as has been the case for quite a few weeks, capacity was tight in the San Diego market. Not a big market, but a large inbound market for coil steel and flat plate and rebar. Outbound rates jumped 33 cents a mile to 262. And San Diego to Las Vegas, one of the big lanes, $4.80 a mile. That's 50 cents a mile higher than the April average and $1.47 higher than the previous year. In Gary, Indiana, one of the big flatbed markets, of course, flatbed rates fell for the third week in a row to $3.71 a mile, excluding fuel. So wrapping up our market update with our year-over-year look at spot rates. As we've been reporting since March 23, when I wrote about the implications of record high diesel prices and plunging spot rates for carriers, an important date, remember that March 23. That trend continues this week. Dry van spot rates dropped by an average of 5 cents a mile last week. They've been dropping by about that amount for the last 7, and they're just at $2 a mile this week, excluding fuel. That's about the same level as what we saw this time last year when the polar vortex upended the freight market. Dry van rates are currently 39 cents a mile lower than this time last year, and about 14 cents a mile higher than the same week in 2018. In the refrigerated market, capacity continues to loosen. Reefer rates typically heat up this time of the year. They're cooling down, dropped another 8 cents a mile this week. The national average is now $2.26 a mile, excluding fuel. That's down 90 cents a mile since the start of the year. The current national average is 51 cents a mile lower than the same time the previous year, and 6 cents a mile higher than this time in 2018. And lastly, flatbed spot rates are now down for the 5th week following last week's 4 cent per mile decrease. The national average spot rate ended last week at $2.60 a mile. That's now down 6 cents since the start of this year. Compared to the previous year, spot rates in flatbed are now 10 cents per mile lower, but still 10% or 24 cents a mile higher than this time in 2018. That's important. 2018 was an industrial-driven economy, largely a flatbed rate rally. still 24 cents a mile higher than that last busy year for flatbed carriers. So that's it for this week's market update. If you'd like to find out more about what's happening in the freight market, go to dat.com/market update and download my weekly report. And with that, I'll hand over to Ned for the short-term forecast.
Hello, everybody. You're going to be seeing, if you've been watching the show for a while, you're going to be seeing some repeated motifs in this week's forecast, but let's sort of dive right in. We're going to begin with dry van. In blue, you can see the market rates observed by DAT, and then off to the right, you can see our forecast models. In red, the short-term model is predicting that the slide will continue with rates hitting about $1.70 by the middle part of June. In green, RateCast, our flagship model, although it's been underperforming in the recent volatility, is expecting rates to continue to slide by about another 5 cents before leveling out and then returning to about where they are right now once we hit the middle of June. Our blended forecasts, which are mixtures of those two models in different amounts and in different ways, are in gold and silver. And the two blended forecasts are leaning much more heavily towards the short-term model, expecting rates to fall by about 15 to 20 cents moving into the middle part of June. But the biggest difference is the trajectory. They're expecting that the trajectory will begin to soften as we head into that period. Next, onto reefer. Once more, we can see in blue the market rate observed by DAT, and then off to the right, we can see our forecast models. In red, the short-term model is predicting that the current slide is going to continue, with rates falling to about $1.90 as we head into the middle part of June. RateCast is expecting the normal seasonality to assert itself and rates to rise, with rates reaching looks like 230 as we head to the middle part of June, with the sharpest increase coming over the next period. Given the general weakness in the reefer market, I'm not sure how much I believe the RateCast model at this particular juncture. Finally, in the blended forecasts in gold and silver, which are mixtures of those two models in different amounts and in different ways, they're expecting the rate to fall, although the trajectory is softened compared to where it's been, with rates reaching, it looks about 210 a mile as we head into the middle part of June. Finally, looking at flatbed, excuse me. In blue, we can see the market rates observed by DAT, and then off to the right, we can see our various forecast models. In green, the RateCast model is expecting normal summer flatbed seasonality to assert itself, with rates rising over the next month, reaching the prior levels of 270 a mile as we head into the middle part of June. The short-term model is expecting the slide to continue and perhaps steepen slightly, with rates reaching $2.40 as we head into that middle part of June. The short-term is in red and the RateCast is in green. And then the blended forecasts in gold and silver, which are mixtures of the two forecasts in different amounts and in different ways, are dropping by about 5 cents, reaching $2.55 as we head into the middle part of June. And with that, it's time for our IQ question of the week, which is, what is DAT doing to take the uncertainty out of freight in these uncertain times?
Wow, it's a great question.
It's almost like you wrote it.
It's a very topical question. It's one of the big questions we've been getting in the last year is, what are we doing to improve the certainty in the freight market given all of the change? But we've been fairly happy, right, Ned, with our model accuracy in the last little while.
Yes. So I'm not happy with the model. I wish it was better, but the model accuracy has been not as bad as I had feared it would be during this period.
Yeah, and an interesting. Oh, sorry. Yeah. Interesting thing to see on those models is that in the past, and I think what we're seeing now in the forecast that just showed, is that during an upset, it is hard to predict. Everybody has a hard time predicting, but after the upset is kind of easing up, the forecasts really do a quite good job of returning to normal. And if today was the last day of all the shocks, it's not going to be maybe, but the new rates from last year's seasonality and the year before seasonality and so on asserting themselves. I mean, that's a strong way to try to say, well, things are volatile, but as soon as they're not, we will get the forecasters as they are get right back on track and from wherever the new set point is and move forward. Kind of neat to see that, even though it is tough to see it during the upsets.
Yes. Yeah.
So, Ned, I think Ken did the numbers on our corn cob plot, right? I think he was talking about a 95% accuracy in terms of which is kind of astounding when you think about how much volatility we've seen this year already.
So we're at 95% for about 14 days out. We're a little worse than that. I think we're at about 6%. We target 4% for the 14 days out. And then for the 30 days out, I believe we're at 8.5-ish to 9%. Honestly, most of the time that tends to level out at about 6% once we get to the 30-day mark. And I assume that I expect that the models will return to those august heights once we get back to that period. But
we're anxiously waiting that the rates to flatten
absolutely
out and return to their seasonal trends.
Yes.
Okay, Haley, so question of the week, what do you got for us?
What do we do to take the uncertainty out? I mean, maybe the first thing to say is, crystal balls notwithstanding, we can't quite see the future, but during volatile times for any industry, ours included, I think the first thing that comes to my mind is that super bespoke business models suffer hard. It's harder to keep a very fine, highly tuned business model when things are changing rapidly. And flexibility becomes more and more important as conditions change around you, as whether it's rates or whether it's fuel prices or whether it's available loads and all of those things. So a lot of the products that we have already and some of the things we're working on in the future are sort of addressing that flexibility kind of value. So a good example right now is we have a new product out. We're currently aimed towards shippers, but we're expanding it to brokers that look at your usage of lanes and loads, the kinds of things that a shipper or soon a broker will be looking at and say, well, here are other carriers that are very similar to the ones you are currently using. And as you need more flexibility in what you're, in your operations, here are other people who are like the people you already enjoy working with. Likewise, for the future, looking at aiming that the other direction, brokers and shippers that carriers may derive value from using. So that's one example of a matching thing. Working on our search results, finding results that are more tuned to the kinds of things you as a user of the platforms are likely to want while conditions are changing and being upset. So you don't have to necessarily follow the same old paths when those paths are not treating you as well as they were.
Yeah.
Could also talk, I suppose, about constant attention to our forecasts, to our market conditions maps, and how we can constantly improve either in engineering ways or in accuracy ways or return to normal ways. All of those mathematics are things our team, Ned, works very hard on, the rest of the team works very hard on. So trying to stem the loss of things from volatility. Dean, you also have a lot of the data sets we have, like upstream signals of volatility. It seems like those are also pretty useful.
We've got there's a lot of external data sets we've got in our data warehouse that we can access that are really good demand signals. The supply signals also, we've got some good data coming in that'll help us on the supply side. That'll help fine tune our rating models for sure. But Haley, I've been here 2 years, you've been here a year. I think that what a lot of folks don't see outside of DAT is how much our team has grown on the data science side.
We are doubled officially now, and we have one more person growing, and a few more that we are going to hire up. So quite a bit of capacity. A lot of that is on the engineering side for care and feeding of the products everybody's already using, making sure those models are constantly improving, and freeing up our researchers' time to dig in on more R&D, more advanced analyses and things like that. So really, really, really fun to see our own internal team capacity starting to flesh out more, giving Ned more people to work with and all of our other researchers more folks to work with.
Ned, talk a little bit about our lane level rating, because it was one of the things we heard at our broker symposium.
Absolutely. I think that one of the big challenges when you're in this kind of a market is that when you're looking at lane level analytics, that is just overall lane capacity, you don't exactly fit in. Your shipments don't exactly fit in, whether you're on the broker side or the carrier side, with how the overall lane is behaving. And so we're working on new tools, new forecasting. It's not really properly forecasting. It's more short-term modeling of what we expect a given truckload to move at, with all the specifics, lead time, weight, dimensions, number of pickups and number of drops, that kind of information, so that you can get a much more customized look at where you are, where your particular shipment is falling on the overall lane behavior. And I think that that's something that can be really helpful when we're in this kind of a market where, particularly on the carrier side, you need to be able to make up on price when you can, given the overall trend.
Yeah. I'm really excited about that whole family of models, because as we as DAT and we as the industry get used to using that tool, the various models that are looking at those very specific details, there's a lot to learn, a lot to do after that to make those even more detailed, even more fine-grained for the specific things you all need in your day-to-day, week-to-week, month-to-month planning. Yeah.
All right. Well, thanks, Haley. Ned, we've got some questions. Let's
let's
dive
I want
in.
to make sure that we address them. Let's start off with Lance. Why are brokers having record profit while truckers are having record losses?
Well, it's an interesting question. I can't speak to the brokers because I haven't actually looked at any of their numbers. I don't know that. Certainly when rates fall and margins expand on the broker side, but the reverse has been happening for the last year. The point that I would make, the counter to that argument, is carriers have had one of their best years financially last year in decades. And when I look, some of the numbers that I've seen from some of the experts in the industry, Todd Amon from ATBS, his group of owner operators that he looks after, I think it's about 15 to 20,000 owner operators that he has on his books. Their average net income was $70,000 last year. So I think carriers, I don't know what period Lance is talking about, but I guess he's talking about since diesel prices skyrocketed in February. Certainly since then, carrier profitability has plunged. So we're coming off a record year profitability wise. I hope carriers have put some money aside for this inevitable rainy day. But carrier profitability is down substantially, and I would say, based on my numbers, what it costs to run my truck and trailer, I would say that we are at about break even right now. One of the ways that carriers, of course, are staying, keeping the doors open, is obviously paying themselves less money, paying them less salary to just keep things rolling. So I think we're at about break even right now in terms of what it costs to run a truck. If you're not getting full cost recovery, you're probably losing money. In fact, if you're just operating on line haul rates only and getting the national average and not getting any cost recovery on the fuel surcharge at 70 cents a mile, my numbers tell me you're losing about 34 cents a mile gross profit. A year ago, it would have been about the same in the positive margin. So things have turned dramatically. I'm not downplaying how severe this is. This is a very acute change. It's one of the biggest financial impacts that I've ever seen in the trucking industry. So, but I do think carriers are much better equipped this year to manage through the market cycle. We've got some very strong demand signals in the market. If carriers can ride this out, we should be in pretty good shape. But having said that, we've now got, talks of diesel rationing and diesel shortages on the East Coast. So this is a crazy market for sure. So Lance, I don't know. I can't really answer that question. I think I'm missing the other data point, which is what the brokers are doing on their side.
Lazar asks, when do you expect fleet operational expenses to start following rates? Trucks, trailers, maintenance, fuel are all still at record high. There's no reason why they have to follow rate. Like in the long arc of history, they are going to, but that coupling is pretty loose. Yeah.
We, as Ken said on the show last week, if the floor price was the break-even cost to run a truck, and let's say I've got it pegged at about 205 a mile today for a truck and trailer, so we're under that now, right? So you would say that if let's just call the floor price for operating a small truck $2 a mile. So if it's $2 a mile, in theory, rates should stop at $2 a mile today and start flatlining or going up, as seasonal forces start to come in. But if that were true, we would never have seen the bankruptcies that we saw in Q2 of 2019, correct? Because rates plummet. Even when demand crashed in 2020, we saw rates crash also. So I think that, we're only as strong as our weakest link. I see a lot of carriers out there undercutting each other and hauling loads that are way below cost just to keep the loads moving. I know what a lot of carriers are doing, because the fixed cost to run a truck sit at about $240 a day. So for every day you're not moving, it's costing you money. So carriers are going to need to keep moving, run more miles, run more lanes, try and get an extra trip in every week. Todd Amon wrote a great article about this on a blog post a few weeks ago about what carriers should be doing. So I think that, Lazar, the answer is, I'm expecting rates to bottom out very shortly. That's the expectation. And then if that's the case, then that means we're sitting at about break even, and that's the floor price. But we'll see.
Yeah, we hope. Gary asks, why are brokers speculating in bottoming out rates in flatbed or flattening the loss of volume in flatbed and reefer? In van and reefer.
I'm not sure I understand the question, but
I mean, it is interesting that flatbed has started to go down, whereas previously the rate declines were confined to flatbed and van and reefer.
True.
Gosh.
True. But on the contract rate side, Ned, contract
Yeah.
rates are fairly sticky when it comes to dry van. Let me have a look at rate view this morning on the dry van side. Contract rates, flatbed, still off the charts, literally.
Yeah.
So we're up over 375 a mile contract, spots down at 344. So I think this is probably a similar knock-on effect, where carriers are opting to haul more freight in the contract market. More routing guides are being repaired, less is falling through the routing guide out into the spot market. So I think if you're talking about rates bottoming out in the spot market, that would be exactly the same trend we've been seeing in dry van and reefer, as contract rates have increased and more carriers are honouring their contractual equipments at the top of the routing guide.
Matt Clark asks, Dean, with the fall off in rates versus last year, have you heard about trucking companies pulling out of the market, closing up shop, etc.?
Not yet, Matt. I mean, that's the expectation, right? But anecdotally, when I talk to carriers, and again, this is a really hard number to peg. I talk to carriers who have had a great year financially, have plenty of equity built up in their truck and trailer, have obviously sold off some trucks and trailers in their fleet to take advantage of record high prices. But they've got enough reserves to weather this storm, to the point where they're parking their trucks, considering parking their trucks and trailers, doing something else, driving for another truck company, driving a combine harvester during harvest season, doing a lot of different things than, one of the analogies I heard that was very appropriate, they would rather go broke at home than go broke out on the road hauling cheap freight. So this is a little bit different this year than 2019 cycle. Carriers have had a lot more equity built up in their assets, and they've got a lot more cash because of the incredible year that they're coming off. Now, that of course won't last forever. But right at the moment, Matt, I'm not seeing anything yet in our numbers. We're seeing some carriers there's still carriers coming into our network. There are still new carriers entering the industry at an incredible rate. So there's no evidence. I looked at the JD Power auction numbers for April. They're down. So, auction numbers on our two largest Class 8 truck auctions hit about 1,050 in July of 2019. So if you think about, what happens when the industry starts to exit, jettison capacity, one of the things that happens is you see a lot of trucks go to the auction block. Not seeing that, we're seeing the reversal of that in terms of inventory levels at auction. So I'm watching that number very closely, because that to me is very telling. But Matt, as we sit here in the middle of May, I'm not seeing that happening. And my expectation is carriers will be able to ride this out, because we've got some incredibly strong demand signals.
The demand signals, I think, are going to be the interesting part, is that if demand is strong as we move into the summer, if there is good consumer demand, then I expect that at some point rates will bottom out and people will be able to just kind of take a little cut and keep going. But if consumer demand isn't strong, then that might be troublesome. Yeah,
we've got that ever-present threat of inflation, right, and what it does to our consumer spending.
A longer term change in the industries around.
The diesel supply side is an incredibly worrying thing. It's 85%. I think it's 85 cents a mile now. So the diesel fuel surcharge is about 70. So diesel's up around 85 cents a mile. It's about 47% of operating costs. It's about 35% of revenue. So, when bankruptcies are peaking, it was about 32% of revenue in 2019. The difference is we've got a lot more profitability in the market. Carriers have had a great year, and that's why I'm more optimistic about the market than most, and carriers' ability to ride this out. It remains to be seen how much of an impact this shortfall of diesel on the East Coast has, though. That's a pretty big story that's emerging. All right, so that's all the questions we have, Ned?
Yes.
All right.
Time for shout-outs.
Yeah, shout-outs. Yeah. I'm on Landline now tomorrow evening at 7 p.m. Eastern. And as always, I'll be on Sales Chatter tomorrow morning with Dan Deegan and DJ Flores at 9 a.m. Eastern. It's Data Wednesday. You can connect with both those guys on LinkedIn. And I think Chris Kaplis has got a new Freight Vine out this Thursday. Keep an eye out for that. Anything else, Ned? What have we missed?
I can't think of anything.
Okay.
Yeah, no, that's most of it. Shout out to the folks who are at the Executive Symposium at DAT.
Right. Yeah, they're all having a pretty good time, I think. I'll be speaking with in Indianapolis tomorrow with Chris Henry at the KSMTA conference. Yep, be flying over to Indianapolis tomorrow. So pretty busy week for all of us, and I think that brings us to the end of the show. We're a little bit over time. Thanks everybody for watching us. That's about all we've got to cover, I think. We've answered most of the questions. So with that, we'll see you all next week at 10 a.m. Eastern. Hope you have a great rest of the week. Thanks for watching.
Bye all.